The local capital markets have responded positively to the Government of National Unity, with the JSE All-Share Index hitting highs in recent sessions and the local currency markedly firmer. Some believe that, contrary to previous years, the local stock market could be ripe for the return of international investors, especially given that South African stocks have been trading at a discount for several years, meaning that there's scope for stock valuations to rise. Well, to share his thoughts on this and more, I'm joined by Paolo Senatore. He's head of equities at Melville Douglas Boutique Investment Management for the Standard Bank Group. Very good afternoon to you, sir. So for the longest time, the local market has been trading sideways with little return for investors who invested, say, 10 years ago or so. Just remind us of some of the factors that led to this.
Hello, Nompu, and good afternoon to your viewers. The real reason why South Africa equity market struggled over the last couple of years, 10 years or so, is that we've had a very low level of GDP or growth in the South African economy. And coupled with that, we've been in a period where interest rates have been lifted and obviously constrained consumer confidence, industrial confidence, for business confidence, for example. So it's really those factors that put South Africa back from a perspective of a stock market rating or re-rating, and difficulty for South African corporates to push through on earnings per share growth. But that, as we can discuss, has somewhat changed looking forward.
Yeah. So when there was confirmation that the GNU had been established after the national elections, market sentiment turned upbeat and we saw a rise in valuations on the JSE. 3 months on, or 4 months on, what have your observations been on our capital markets in terms of value appreciation, including bonds, which are also traded on the JSE?
Well, both the bond market and the equity market have shown a rally, and so they have price appreciated. Part of that, of course, is the GNU and the stability that investors see within that, and of course, certainty with regards to economic policy that it may bring. But there's more to it than just the GNU. There are a number of factors that are also working in South Africa's favor. For example, inflation is around the 4.5% zone or so, and so that allows for interest rates to be cut. GDP growth rate this year will come out at about 1%, but next year will come out at about 2%. So there's growth that's moving in the right direction. And then, of course, for companies operating in the South African context, things like load shedding have come off, and that allows for an increase in ultimately earnings per share. And so there's a lot of confidence from the business community, from the investor community. And remember, in the South African context, we've seen funds flow out of South Africa in the past. But if we start to see an improved environment, there's a strong case to be made that funds, both foreign funds and South African funds that have left the shores of South Africa, given that the National Treasury allowed foreign exposure on pension funds, for example, to go up to 45%, some of that money coming back into South Africa. And of course, bear in mind, the South African market is relatively small in its size. So if you get international markets and international investors are underweight South Africa, if you get funds flowing back into South Africa, and of course, in a relatively small market with confidence behind it, you can see the market re-rate. And our market is relatively cheap. We look at our market on a PE, a price to earnings ratio of about 10-11. But if you look, for example, just as a proxy at the US market represented, let's say, by the S&P 500, it's over 20, and the very high-tech index of NASDAQ, which is, shares like Google and Apple, that's over 30. So our market represents value and can easily re-rate, provided the positives of improved GDP growth rate, contained inflation, and a cut in interest rates, which we expect to start on Thursday, of course, by potentially up to 25 basis points and potentially another 25 basis points in November. So besides GNU, which is hugely important because you need the stability of the environment and economic policy, you also have other factors that are driving the South African market, making it quite attractive. And what we have seen, which is interesting of late, many South African companies, because it's an easier operating environment, producing really solid earnings per share numbers coming through.
Yeah, you touched on the whole issue of monetary policy easing that's expected to take place, and obviously in the United States as well. With that, does that then make emerging markets like South Africa more attractive for investment, as traditionally, of course, developed nations have had lower inflation and lower interest rates vis-a-vis emerging markets, and no doubt that sort of equilibrium is going to remain going forward. Do you think that then makes us more attractive just on that issue alone?
Well, I think it's more than just that issue. I think it's the comfort of South Africa as an economic zone being ready for growth. But certainly it can help. The cutting in interest rates in the US, Europe, South Africa, of course, all leads to the potential of improved confidence and economic growth looking forward. Of course, the cutting interest rates will take 6 to 9 months to really filter through. And that's why I said earlier, this year we'll have GDP growth in South Africa of around 1, but next year around 2. So that moves in the right direction. Certainly, when you look at in the US, a 25 basis point cut is more aggressive than a 0.25% cut in the South African context because our interest rates are higher. We may even see, for example, the rand strengthen on the back of that, simply because on a relative basis, our real yield from an interest rate perspective remains relatively high. So the rand could strengthen as well. But certainly the cut in interest rates in large parts of economic zones of the globe will lead to some kind of confidence that economic growth, consumer confidence will pick up 6 to 9 months looking forward. And that would be very strong from an emerging market perspective, provided there isn't a risk-off event. And of course, the world is troubled by many events. And in the South African context, the one aspect we do have to worry about or be concerned about is our debt to GDP. So we are quite indebted in a way. We've got to make sure that that doesn't come out of control. But with economic growth, your tax collections start to improve and you can pay down some of that debt. And so theoretically, we could improve on our debt to GDP levels. And what would really be strong for South Africa, it doesn't really look like at the moment, is a commodity cycle run, because that would really require China to be supportive of the commodity cycle. And unfortunately, at the moment, they struggle to find some traction in that space from an infrastructural spend. But that would really be, if I may use the term, the cherry on the top for South Africa, if we do get a commodity cycle in our favor as well.
Yeah, well, we wait and see. Paolo, thank you so much for your contribution there. That was Paolo Senatore, his investment strategist at Melville Douglas.